In this week's video, we'll describe why flexibility is required for both bulls and bears as we head into the new trading week. Later in the video, we'll review several charts that tell us from a trend perspective we still don't have a clear winner. We had mentioned in the past, and we'll show again why 1640 remains an important level on the S&P 500. We'll update our study of the current market versus vulnerable periods in 2012. We'll describe why we have tentative improvement in our models and from a technical perspective. And we'll close the video with the Big Four CCM charts. For those of you that have been following along on short takes and or Twitter, you know we've been backtesting over the past 4 weeks new rules that we added to our asset allocation process, and we're happy to report the backtesting project is complete and our models are up and running and alive and well. We'll cover the models and the backtesting project in more detail in subsequent videos. For now, the purpose of the models and rules is to take all of the charts and indicators that we use and convert them into an implementable game plan. The 2 biggest questions that you have to answer to get started to be successful: how much of my portfolio should I allocate to risk assets, and what percentage should I allocate to more conservative assets? This is a small portion of one of the spreadsheets that we used in the backtesting project. A fair question may be, why did it take 4 weeks to backtest your models? Were you curve fitting? And the answer is no. What we were doing is collecting historical data to be used as input into the model so we could gain an understanding of what the model would have given us from an allocation perspective, for example, on 12/31/2002. Biggest thing the model gives us is a recommended exposure to conservative assets and recommended exposure to risk assets such as stocks, precious metals, emerging markets, small caps, etc. We'll go over this spreadsheet and the models in more detail in subsequent videos and weeks. If you want to see some of the historical data, you can go to our website, www.shavacocapital.com, and in the left-hand margin, there's portfolio models. There's a moderate growth model here, gives you the historical data you can review from a backtesting perspective. There's a little bit more aggressive growth model. Before we head to the charts, just want to reiterate the importance of being flexible. We have recaptured the 50-day, at least for now, on the S&P 500 that we mentioned using this slide last week. However, until we get a convincing close above 1640 on the S&P 500, we really need to be agile and flexible and keep an open mind. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Since the market hasn't convincingly broken out to the upside nor deteriorated in a bearish manner, we'll move through these charts relatively quickly and we'll review charts that we've reviewed in more detail in past weeks. It's a daily chart of the S&P 500 with various moving averages. You can see when the stock market is near the blue, the red, and the green moving averages here, which are the 50 in green, the exponential 20-day in blue, and the exponential 40-day in red. This can be an indecisive, volatile period in here. Indecisive and volatile, resolve to the downside. Indecisive and volatile, resolve to the downside. Indecisive and volatile, resolve to the upside. Indecisive and volatile, resolve to the upside. Don't have clear resolution yet, and we'll show on some other charts why 1640 could be important. We did recapture on a closing basis, at least for the time being, the 50-day moving average. We closed at 1631 and change on Friday, July 5th. The 50-day was at 1625 and change. And the EMA 40 and the EMA 20 both sit at 1616 and change. So there is some progress here, but still a lot of uncertainty. It's another daily chart of the S&P 500. We've got this downward sloping trend line. Here we hit the trend line on Friday. It acted as resistance here, resistance here. It's possible it will act as resistance if we can go into the 1640 range. Why that's important, we would then be above the 50-day with a positive slope. We would also be above this downward sloping and potentially bearish trend line. If you're a bull, you'd like to see this momentum indicator, which is weak. This is a weak Williams percent R that also tells us to be careful. We'd like to see Williams percent R look like this, or this, where gains tended to follow in the S&P 500 index. This is one of 5 models that we use as inputs in the asset allocation and rules model that we just tested over the past 4 weeks. We've reviewed this in the past. We were looking at vulnerable periods. We had a score of 17 or 33 in 2012 on a scale of 0 to 100. That's a concerning score. From a good news perspective, the current market has moved back to a 63. You can see that's a higher score than we've seen in some time. The but that's coming, the S&P 500, which is the most important chart and the highest weighted chart in this model, is still only registering a 45% on a scale of 0 to 100%. So until these numbers can get into the 50s, 60s, or 70s, there's still some concern that aligns with the concerns with the trend line and the fact that we're still floating around the 50-day moving average. We've been showing that there's been no clear resolution on some of the shorter-term charts. Same can be said for this longer-term chart that we've looked at in the past. We still have this trend line here that's trying to act as support. If it gives way, that would be concerning. We could see a move something like this. For now, it's acting as support, and we will respect it as such until something changes in a bearish manner. When we looked at the results of one of our models in Excel, we saw there was improvement getting back to a 63 on a scale of 1 to 100, or actually 0 to 100. A lot of the improvement in that model comes from bullish moving average crossovers that have taken place on many of the charts in the model. You can see as of Friday's close, the exponential 3-week moving average closed slightly above the exponential 5-week moving average. Price closed above and the slopes are turning up. This period here looks similar to this period here, and we have to admit that this really doesn't look anything like this anymore, nor anything like this or this. You can get whipsaws, as we saw here and here, so we have to keep an open mind. But for now, there's no question there was some improvement from a moving average perspective in our models. Everything that we said about the last chart, which was the weekly S&P 500, applies to the second chart of the CCM Big Four. This is weekly longs versus shorts. Similar improvement. This is chart 3 of the Big Four. This is stocks risk on relative to the aggregate bond index, AGG, or risk off. We noted in last week's video and or on Twitter via a tweet of this chart that what happened in this area could be very telling. Well, it's difficult to look at this chart and say that at least in the short term, the resolution appears to be bullish. As long as this chart looks like this, it tends to favor the bulls. The however is, this is interest rate related. If interest rates rise too fast, and this chart rises too fast, it actually could become a bearish development for risk assets. So if you're a bull, you'd like to see this ratio rise in somewhat of a controlled manner, so interest rates could rise in somewhat of a controlled manner. This is chart 4 of the CCM Big 4. This is riskier junk bonds, JNK, or risk on, relative to more conservative treasuries, TLT, or risk off. Similar situation. This is a bullish profile. This looks similar to this period here where stocks did well, or this period here where stocks did well. As long as this chart and the credit markets lean in a bullish manner, all things being equal, that's good for the stock market. Just revisiting a chart we've looked at in the past, this is HDGE, a hedge relative to the S&P 500. This chart has also lost some of its bearish look. When it closed on Friday, July 5th, it tended to favor bullish outcomes in the stock market. Like the credit markets, or JNK relative to TLT that we looked at previously, the weekly chart of the IWM, or Russell 2000 Small Cap ETF, still has a bullish look. Price above blue, price above red, blue above red, slopes of both up. You can see typically when the stock market corrects in these areas that small caps take on more of a bearish look, like this, or this. As long as this holds, it also tends to lean towards the bullish end of the spectrum for the stock market and risk assets in general. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.